morning, Andrew.
Yeah, morning, Chris. How are you?
Not too bad, mate.
It's good.
Here we are again. We were just saying, comes around quickly.
Yeah, it does come around quickly, and probably not a lot really to update on today. It's more affirmation of trends and themes and key discussion points from a number of updates now.
Yeah, yep, definitely. So good segue into key points for this month.
Yeah, so key one there is just the calmness that's been restored following some reasonable strong downward volatility towards the end of July and early August, which it spooks everybody.
Absolutely.
About what can create a bit of panic, and obviously the media updates, the news, it's all doom and gloom. So as you and Shane covered off last month, it's about things will be okay. Just stay with it. Things will recover and
hold through.
Hold through. So across the Eurozone, inflation continues to fall. So they're getting close to, their underlying targets that they're trying to reach. Yep. Meanwhile, in Australia, it's still remaining fairly. The high inflation is still remaining fairly resilient. So it's trending down, but it's taken a while to get down to the targeted levels, and with that, the expectation or the reinforcement that's come from reinforcing from the RBA, saying CPI remains our number one target. So hell bent on getting that under control to target, which is expecting the expectation then is for rate cuts to come into 2025, not beforehand.
Definitely. And I guess we'll address this when we get down there, but we think that's not necessarily unexpected given we started later in terms of the rate rise cycle. All right, so some calm's restored. For those of you who can view the chart pack, as always, if you're listening through the podcast, it'll be in the show notes. If you're watching this on YouTube, it'll be a link in the description. But you'll be able to see, obviously we had the big drawdown, I guess, in early August. But subsequently we've seen the recovery, which to your point, Andrew, probably hasn't been as widely publicised in the news, the return upwards versus the retraction.
Yeah, and look, we probably sound a bit repetitious here, but you could look back over many, many years prior, and volatility is always there.
Yeah, it is,
so
absolutely.
It's about, we keep repeating ourselves, but if you've got an investment strategy, stick to it, stay with it, stay the plan, and things will eventually normalise.
Yeah, it's interesting though on that exact point, where depending on the frame of reference that you look at it through, I suppose. So if you're looking at it in this frame of reference here, where we're looking at what's that, 6 months or 8 months, 9 months. Sorry, my brain's not working quite yet. Just to the volatility looks quite strong, and then if you flip down to the slides in later on when we're looking at total equity returns over, that's a time frame from sort of 2014. The frame of reference you're looking at there on the left-hand side, which for those of you on the chart packs, page 8, the volatility is significantly smaller.
Yeah, it's a lot more smoother.
Yeah, definitely. Yeah. So it's definitely in the frame of reference. And to your point about your investment strategies, our investment strategies are 5 to 7 to 10 years. That should be the frame of reference that you're looking at the volatility through.
That's right. Yeah.
So Eurozone headline inflation continues to decline. As you said, I guess that's what the ECB have essentially been trying to drive. But I guess that's had some effect, I suppose, on the unemployment rate as well.
Yeah, it has, and I think the all heading in the right direction, and as per the plans of the central banks there.
Yeah, definitely. It's interesting to know there that there's been a slight uptick, I suppose, in the US unemployment rate, which again I think is something that the Fed are looking for, given that services or wage inflation was one of the things that was keeping interest rates elevated in the US. It's always a weird construct, I think, for all of us here,
Yeah.
where you're hoping for unemployment to rise, which means people are out of jobs and under stress.
Yeah.
But from an economic standpoint, I guess that's essentially what we're trying to engineer, so that there's less pressure on wages.
Yeah, and certainly that's what the that's what the RBA keep banging on about, that if you let inflation continue out of control or elevated, then that'll be more pain on the economy than what they're trying to achieve through the policy setting that they've embarked on.
Yeah, correct. So I suppose from an Australian context, we would be looking for something similar, where we start to see what the US there is that pink line on slide 5 for those who are following along. You can see in the US there that we're just starting to inch up. Japan there similarly, but it's been pretty flat. But as you can see, the Eurozone is kind of coming down. So, but they have had structural unemployment issues for a long period of time. Like, I think I remember it was about 2015 where we were going through the Greek sovereign debt crisis, and unemployment was a significant problem for the younger cohort. And obviously, some of the policies they've put in place have started to address some of that, and it's coming back down to, I suppose, what you would call a more normal,
That's right.
more normal global standard, which I think is a good thing in an economic sense, and also obviously more employment means less stress on a societal level.
Yeah.
That's interesting data there. And then Australian inflation, continues to remain high. So we had a reduction compared to the June reading, which is good, but still elevated.
Yeah, and some of that would have been or maybe it was too early, but some of it would have been the energy rebates, and both federal and some state governments have introduced some energy relief. So no doubt it's playing a part there as well.
Yep.
But interestingly, just on the retail sales, they were flat in July. I mean, one month of data of tax cuts doesn't necessarily set a trend, but it's a small piece of evidence that people aren't out there spending their tax cuts.
No, absolutely not. Yeah, and I think anecdotally that kind of aligns with probably what we've heard from clients, is that a lot of the focus at the moment is just, if you have debt, it's reducing debt.
Yep.
And putting money into savings, because everyone realises at the moment it's pretty tight out there.
Yeah.
So
Yeah.
which is I guess I suppose a good thing from an economic sense, that if we saw retail sales go up, it's a data point for the Reserve Bank to mount the argument that people aren't necessarily taking heed of the interest rate environment. So probably a good thing.
And the last statement there, as we've already touched on, the RBA has reiterated that they will not cut rates this year. Do you see any chance at all that it might be a cut?
Not based on the current data, no. I think inflation would have to really significantly decline rapidly. And if that did happen, I think we'd have probably some bigger issues at play.
Yeah.
So I guess coming back to what we've spoken to over the last few months is, Australia's interest rate rise or interest rate cycle, we lagged the US and Europe by 6 to 8 months.
Yeah.
And so subsequently, the lag effect of interest rate rises, so typically it's sort of 12 to 18 months to feed through into the economy. That delay in lifting rates has meant there's been a delay in the translation of that into the economy. So subsequently, we hit our peak later, and then what we, I guess, would see is that we start to cut rates later.
Yeah.
I think Shane and I addressed this last month too, where our relative height of interest rate rises, we didn't go as hard.
Yeah.
We started later, and it might have been 2 months ago when we did the last one.
That's right.
We started later and didn't go as hard during the rate rise cycle. So subsequently, the knock-on impact of that is a more muted, I suppose, impact.
Yeah.
Yeah. So, well, let's see on the interest. I guess depends on which side of the fence you sit on, whether you have a mortgage or whether you've got cash, whether you're happy that interest rates are higher for a little bit longer. But I think that the consensus and expectation is that they're coming. It's just, we're here in September already, so before we know it, it'll be Christmas. So,
Yeah.
So a quick grab, I guess, on households in Australia.
Yeah. So the the quick call out here is for those that can't see and only listening, the chart on disposable income and consumption. So disposable income has slightly crept up in recent times, but the consumption has continued to fall. So they're going in opposite directions.
Yep.
As we've mentioned previously, also on that same slide, in the bottom half of that chart, the savings ratio. So savings have really been depleted over the course of the last couple of years for obvious reasons. And the chart on the right around consumer sentiment. So all these charts are all kind of aligned and linked. So consumer sentiment still at those those lows.
Yeah,
for quite a while now.
Quite a while. That's sort of a 15-year. Well, it's not the lowest point, but we're still hanging around, that sort of 75 mark on the index. Whereas, like, you look at that, and the average is probably somewhere around 95, I suppose.
Yeah.
So the general view out in the population isn't particularly rosy at the moment.
No.
And I think that's just reflected in, again, the conversations we've been having with clients and the general feel, I suppose, of the finance news that's out there too, is that there hasn't really been too much positivity or buoyant positivity really in the last 12 or 18 months, which obviously then flows through to how people feel about the world.
Yeah, that's right. Yeah.
Right. So I guess we came back to this chart earlier around, I guess, equity market returns, and I suppose if we flip through back up to the first slide there, to just sort of say, well, that was 9 months ago, we're 15% higher, I suppose, than where we were 9 months ago. But in the longer term context, it's been a pretty good run, really.
Yeah. So what we're looking at here are index returns for the MSCI International Index, the S&P 500, which is the US index, the Vanguard Australian Shares Index ETF, which is the Australian share market index, effectively.
Yep.
And the important note to point out here is while the short-term returns are somewhat important and relevant, again, to your point, it's more about what's happening in the longer term. So if we look at the table on the right-hand side, 5-year annual returns, you can see there the international and the US index returns have far exceeded the local returns, and I think that really points to, again, a theme that we've spoken about numerous times: diversification and why you can get some reasonable returns with local exposure and diversification domestically. Ideally your portfolios or your investment exposure should be more broader than that.
Yeah, absolutely.
To benefit from global diversification.
Yeah. And this is again a conversation around people's comfort levels, because they feel like, all right, I live in Australia, I know who these Australian companies are, that makes me feel safe and secure.
Yeah.
But then sometimes you need to just slightly step outside of your comfort zone just to sort of, what about some of the bigger companies around the world? And it's beneficial in that context to the tune of, I said, like somewhere between 6 to 7% per annum over the last 5 years. So by I guess taking that protective, comforted approach, it's been significantly detrimental from an overall wealth perspective.
Yeah. And you couple that with it's not about trying to pick what the international share or which what equities you select. Again, it's the philosophy around index-based approach. So you get you're not trying to back the next winner or which company might outperform others and their peers. It's about backing the index and the passive approach that we endorse, as you all know. So it's really important that also is part of the strategy. So one of diversification, but also two, back the market, back the index.
Yeah, absolutely. Yep. And so on the other side of that coin, I suppose we've just looked at our growth exposure and looking at the bond markets. This is, I guess, what you would consider our defensive allocations.
Yeah, and these are all about getting largely capital preservation with a bit of fixed income in there and getting a steady yield.
Yep.
Having said that, the prices of bonds do flex with interest rates, but in the opposite manner.
Yeah,
and you
correct.
can see the recent pickup in the bond prices, or in the on the left-hand side there, the uptick in the trend lines there is the forward-looking expectation that interest rates are on their way down, so the bond prices are priced accordingly.
Yeah. And it's interesting, it's been a particularly difficult space to be in for the last 4 or 5 years because of that interest rate dynamic where we had interest rates fall, so bond prices went up, and then the inverse has happened, and obviously we had big sell-offs in bond prices. So it's been hard over the last 5 years for people to kind of look at the more recent levels of return and say, why am I in this? This is meant to be defensive.
Yeah.
But I think going forward, the expectation is that the interest rate environment is going to enter a more normal, in air quotes, environment where we don't see the huge swings in up and down. We should be back to a more, incremental approach, which should put the performance numbers back where they should be, and into a relationship where you're having like what we will call the correlation of your defensive part of your portfolio and your aggressive part of your portfolio acting in opposite manner to be a ballast.
Yeah.
Whereas for the last probably 4 years, they've been quite correlated.
Yeah, they have, and that's all around the economic environment and climate. But what happened with the bond prices has been a very, very steep and aggressive interest rate increasing cycle. Certainly the most aggressive cycle over the last couple of decades, and that's played havoc with the bond prices. So I think, I guess what we're saying now is that now's not a good time to jump out of bonds.
No, I don't think so. I still don't want to be talking about predictions. If I put my crystal ball hat on, if we have an expectation of rate cuts to come down, this is a good part of the market I think expectations are this is a good part of the market to be invested in.
Yeah.
So, and it's one of the dangers of trying to make your forward-based investment decisions on short-term historical numbers. It's incredibly dangerous is probably the word I would like to use.
Yeah, absolutely.
So. And our usual charts around market timing that we put in this year, this month we've updated from the last few months. But as you can see here, we're still part of a bull market currently. But what this says is average length of bull market's 1,000 days. Average length of a bear market's 282 days. So it's just a matter of we have more ups than we do downs, and we need to hold the strategy essentially.
Yeah, that's right.
Excellent. That's it from us for this month. As Andrew said, I think it's a relatively benign month, essentially, especially after the last couple of months. But I guess if anyone's got any questions, please feel free to reach out. But otherwise, we'll see you next month.
Yep, thank you for watching and listening.
Yep.